Okay, welcome everyone. We'll start our new unit, which new subject which we are going to start, which is unit 3, financial and management control. My name is Anjum Sathar and my email address anjum@ukversity.co.uk. If you have any questions, please drop me email. Before starting this unit, first of all, we'll look around what is the aim of this unit, why we really want to learn about this unit. The aim of this unit is to develop the financial management skills. So you have to think about the management and financial management. So financial accounting is external, financial management is internal. And management is a process of designing an environment to achieve pre-selected objectives. So we want to be set an environment where we can measure the performance in the financial and non-financial terms to achieve our organization objective and long-term our organization. So that's skills we need to develop. Of those who manage or seek to provide the information performance management. So performance always equal to time, cost, and quality when we look around the performance. Continuous improvement. Yes, organization need to be continuous improvement. It's not just you performing this year well and you expect next year will as well, and always looking to be reduce the cost, bring efficiency, financial control, and the management of internal risk in the small and medium sized enterprise. That we'll discuss. Small and medium practices, which will go through. Learner will be able to use the analytical tools to evaluate the performance. So different tool like financial ratios, like we can look around balance scorecard, and we can look around various other models, to use and evaluate and measure the performance, and able to use these techniques to implement budgetary and financial control, evaluate and manage internal risk. So all this will be in our discussion. Okay. We have for this unit, I can show you, we have five learning outcome, which will go through each week, one learning outcome.
Yeah.
And that will be the key, So, sorry, I think so. Downloaded but not being properly saved somewhere. Sorry, my we're doing financial management control. Yes, this is our unit spec, which you receive email as well.
Yeah.
Okay, so it will open. Okay, so okay, so you can see now. This is we have the unit spec, what we're supposed to be learn. Today lesson we go through LO1, learning outcome 1, which is about understand how improve business performance. That's LO1. And then we have assessment criteria, evaluate actual business performance against the business target, which is mean budgeted. Evaluate the cost reduction method, how we can reduce the cost, and propose the appropriate, the performance improvement. Then if we want towards merit, assess the continuous quality improvement, how we can do. Then LO2 will prepare the budget variance, which we will look in next lesson further in detail. And the lesson 3, sorry, we have a 3 learning outcome. And then the lesson 4 will be our assignment discussion. So that's all we'll go through in our lesson. And we'll be given the content what we're supposed to be learn each lesson. Okay, so that's all, so we'll start now. So first of all, we have 1.1, evaluate actual business performance against the target. So before, first of all, we'll start, because we're doing financial management control. First of all, always we need a data to use to prepare the management accounts, and the financial account normally is the internal. So difference between management account while the data is used. So if our financial management control, we need the data, that's why we can control it effectively. So distribute internally within a business, management decide, the way which they can present the data, help, management planning, controlling. We It's good to be know the difference. Financial accounting is external, like we prepare the financial statement. So that's why we included this slide. Okay. Next, when we're looking the budget. Budget is a financial plan for future.
Yeah.
So budget can be fixed and flex. Fixed budget means the budget will stay the same. It won't change like a fixed cost. We have NHS, which time has increased from 3 hours, sorry, not 3 years, 3 hours to 6 hours. Yes.
Yeah.
Why? Why A&E waiting time has increased from 3 to 6 hours?
So don't have enough stuff.
Okay, good. So we don't have staff. Okay, what else? So if we don't have a staff, why we don't have?
The budget is not enough.
Sorry?
The budget, like
Budget. Yeah. So budget was fixed budget.
yeah.
Yes. The population increase. Yes.
Yeah.
Population increase. Budget not
Not
flat.
increase.
Yes.
Yeah. Not increase.
So budget wasn't flat. So if your 1%, let's say, if every person visit you will give you, let's say, £100. So million people know is 1.5 million. So we have same budget. The person increase, and we don't have a staff because we don't have a budget, so we can't recruit it more. Yes.
Yeah.
Ultimately, what's happened? The waiting time, our benchmark, that was the 3 hours to serve. It went up to 6 hours in waiting time. So that's a huge, yeah. So we
Yeah.
can't really realistic target if we have just. So we have to flex the budget according to the situation. So think about inflation. Last week, government announced inflation figure. Do we know how much we have inflation? How much in UK we have inflation?
Is it 8.91 talking about?
No, it's 2.1. Huh?
Oh.
2.1.
You're talking the info. I thought it's minimum wage. No, it's not.
So in UK overall is according to ONS, it is called Office of National Statistics, where we can get the figures
Yeah.
that gov.uk regarding these. So that's we can look around because that will affect our budget. Okay, when we do the budget, always you have to be aware of cost behavior. What is the cost behavior? Fixed cost, the cost won't change. Variable cost which change with the level of output. If you produce more, overall your variable cost will be more. But the unit variable cost, technically, unit variable cost should go down. Yeah. Okay. Then semi-variable. What is a semi-variable? We heard semi-variable. Or we learned semi-variable?
No.
Okay. Semi-variable cost.
I think it's split this between fixed and the.
Yes. It is. So semi-variable, like if we look around landline phone, yes.
Yeah.
So we have a line rental. So line rental is a fix. Yes.
Yeah, that's right.
And the calls are variable. We can argue here, we can get the package unlimited, but call normally variables. Huh?
Yeah.
So calls are variable cost. So if you have like pay as you go, meter in house gas electricity, we have a standing charge. Some people charge say daily service charge. So daily service charge is a fix,
Mm-hmm.
and the unit just times by variable cost per unit is a variable cost. So we can calculate the total our gas electricity bill. So always we need to look around the unit cost. Okay, this is the variable cost. Okay, is it fixed cost always fixed?
No.
Fixed cost is a fix up to the capacity.
Yeah.
So up to the capacity is a fix. Yes. If
Mm-hmm.
we have a more than capacity, like we can sit 30 people in a room and we have a 32, we need to hire one more room. So we call step fixed cost. So step fixed cost mean my cost will go next step. So I have to hire one more room. So all these, especially hotels, like you will see during week, especially buffet and food prices during week is cheap, yes, low, because the fixed cost is still they have to pay the rent. So they want, even they work at the break even where they don't earn any profit that period, but at least they are covering their fixed cost element. So we have to look around if we have an office and we paying rent and we are just using one chair, maybe less is someone else can use or someone else can share or the post can someone come. Lot of companies or offices they share things. So ultimately why they share? They want to really reduce the fixed cost.
Yeah.
Okay. So that's we need to be keep in mind when we make the budget. Okay. Flexing basis. Okay, we make a original budget 100 units manufacturing, but we were manufacturing 150 units. Can I compare 100 unit cost with 150? No.
No.
150 unit cost will be higher, of course.
Yeah.
So
Yeah.
what we need to do, we need to flex it. What is my 1 unit standard cost or the
Cost. Yeah.
budgeted cost and
Mm-hmm.
times by 150 units,
Mm-hmm.
and then we'll find the variance. So we look in this example. We've been given here budgeted unit 50,000. Yes.
Yeah.
If we do budgeted unit 50,000, our cost is 150,000. Anything? Uh, just give me, I think so. I not miss one file. Give me 1 minute. So I think so. That's why it's full not example. Okay, so what we can do, we can flex it, yes?
Yeah.
So we can flex according to, so we can look this example first. In a okay, budget. My gone. Okay. Yes, it's how. Basically like this. Okay. So go back to. We look here in this example. We have budgeted unit how much? 50,000. Yes.
Yeah.
So 1,500,000 divided by 50,000. What um £30 each unit? Yes.
Yeah.
And actually, how many units we are producing? 7,500. Yes.
Yeah.
So you times by 30,500, 37,500. So we'll we should get 112,000. Sorry. Yes. 112. Yes. 5,000. So 1,500,000 divided by 50,000. So our per unit cost was 30 times 37,500. So we'll get 1112. That's given here on the next slide. Huh? So our flex budget should be 112. Yes.
Mm-hmm.
So actually is how much for 37,500 units? 107. Yes.
Yeah.
So there is a difference because my revenue should be 112 according to 37,500 units, but actually is 107. So there is a variance adverse. Why is it adverse? If you look 107, 5,000 divided by 37,500, it's I'm selling £28 and 67 pence per unit
Okay.
instead of £30 per unit. That's the reason my revenue is lower because I dropped the price. You getting me where I'm coming from? Yes.
Yeah. Yeah.
So first you look what your budgeted because that was the budgeted for 50,000. You find
Mm-hmm.
one unit selling price and times by the actual sales you have. And actual revenue always because of course what actually you receive. Then that you can find the difference. Huh?
Mm-hmm.
If we look the fixed budget, not flex, so there was the variance 42, yes,
Yeah.
4.2. So that's was, but actually it was quite less because the reason we sold 13,000, 12,500 units less. Okay, that's the way we need to flex the budget. If we'll go next, then we have a material. So we've been given the material of 50,000, 37, 5,000 divided by 50. So you get the 1 unit. To make 1 unit, how much material required? So you do 37, 5,000
Mm-hmm.
divided by 375,000 divided by 50,000. So we'll get 7.5. Yes,
Yeah.
7.5 times 37, 500 units. That gives 28. So according to the flex, that should be 28, 1 to 50, 28,100 200 and it's 281,250, but actually we have 311,750. So there is a variance adverse because my actual cost is higher than the budget. So these variance. So why is the variance? What do you think? Material variance. Why material variance? Material
But.
have two variants. Material cost variance have two sub-variants. One is called material price variance.
Mm-hmm.
Second is a material usage variance. Usage variance, yes. Why? Because maybe you got the cheap material from China with respect, yeah, and actually due to the low quality material, we have used more material. Yeah, we
Yeah.
consume more. But we have to look around overall, is it the variance or the cost? Is it a favorable or adverse? If it's a adverse, so it's no point you use the low material quality, yeah?
Yeah.
So we need to be think about those lines and the causes of variance. These are the causes of variance. Then same with labor variance, labor cost variance have two sub variants. Labor rate variance and labor efficiency variance. So if you maybe this is your favorable because you're paying less to you set £8.91 an hour, maybe you find it's illegal to do, but just argument you found £4 an hour labor, yeah?
Yeah.
So that £4 you saved it £5 now on the labor rate. But what productivity labor gave you an hour, yes? So overall your variance, if it's coming adverse, so what's the point? And labor variance also linked with the material as well. If the labor not trained, it can use the more material, or the quality or the customer service will drop. So all these we need to be look around, yes,
Yeah.
factors. So these are the causes of favorable and unfavorable all written. So always sale variance. If the favorable, you're selling more than the budgeting, always in your favor. So always need to be think about what we can or how we can make the favorable. Huh?
Yeah.
Any question?
No, it's fine.
Okay, next we're looking 1.2 evaluate the cost reduction method. There are cost reduction. How we can reduce the cost. We look around outsource. We look is a fixed cost. Yes.
Yeah.
Of course, maybe a fixed cost I can't reduce it. Maybe I look the variable cost to reduce it, or maybe I'll think about to reduce per unit cost. How we can reduce it? If I'll produce more and more, like if I'll say my fixed cost is 1,000, my variable cost £2 per unit, and I'm making 50 units. Yes. So my total cost is 1100. Yes. So if I'll divide 50 because I'm making 50 units, so what is my per unit cost? Huh?
Yeah.
What will come? So divide it, yes, 1100 with 50. Yes, so it's £22 per unit.
Yeah.
So now, if now your client base is increased, yes, two, and now you have, let's say, 200 clients, yes, still you're
Yeah.
paying the rent is £1,000 per month for the building. So now, think now, what is cost now? So it's 1400, yes.
Yeah.
If you divide now with 200, your client, what is the per unit per client your cost? So 1400 divided by 200, now
7.
it drop from £22 to £7.
Yeah.
So you will see there, this is the huge difference, yes, if you're working at the full capacity. So that's why we've seen unfair in first bus or various other to reduce and giving £2, £5 ticket to London, because the reason is they want to use the capacity. So standardization is mean budgeted cost, and we can look around the actual is the advantage. Of course, we can control inventories, we can look around efficiency, we can compare with budgeted time and time, actual performance, actual reading. Yes, so all these we can look around. Okay, then disadvantages, because sometimes standard. We set the standard 10 years ago. Maybe they're not matched with. It can be um, ideals. There are different types of standard. Ideal standard, which is the ideal situation. There is a no variation allowed. Yes. So what we can do, we can make the current standard based on the current environment. Yes. Because if you set the standard 5 years ago, the national minimum wage was let's say £6.50. Now it's £8.92. So what you will do, your standard is outdated. Yes.
Yeah.
So standard regular need to be reviewed to reduce the cost. Cost reduction, we need to have a team can be used to identify the scope of achieving the cost reduction wherever scope we have. If you are the manager, you are late and you expect your worker will work. Yes, it's not. If you don't have as a manager skill, how you can get the work from the worker? Yes, if you don't understand the culture, which country we are, and think about if the manager is sitting with the workers and offering them tea and sitting and drinking tea with them, if their motivation level will increase. Like it happened in one of our ambassadors went to the park and he start cleaning up, pick the rubbish, put in the bin, and actually that they seen on the social media, and then they realize that public, come on, is the money the counselor is doing some other country and cleaning the park, and they try to follow it and they clean whole park. And due to this one action of that person, so we can make as a manager difference in our organization performance. So that's we can look at. Then next we have a target casting. I want to be my cost. I want gross profit. Let's say 50% my gross profit. So what is my target cost? 50% my target cost. Yes.
Yeah.
So I need to be check. I'll always keep target cost. So if my this cost will go 55, my gross profit will go down. Yes.
Yeah.
So we need to be. So target costing will help us to make the plan for the future. Okay, you will see here we have a market price. We required margin 15%. So 15% is my gross profit. So 500, 15% is 75. We want gross profit. What will be target cost? 475. Any question?
No.
Okay, these are the target costing also help us to reduce the cost. And okay, next we have a value analysis, or we call value engineering. Okay, this involves assessing the value of every aspect of the product, devise the way to achieving the purpose economically, as well as maintain the required quality standard and reliability. So conventional cost reduction technique try to achieve the lower production cost for a specific product design and try to find the least cost method. Like we couple of maybe heard about lean management or lean cost. Like just in time is a lean cost. Yes, you only buy when you need it. Yes, or think about outsource. Yes, think about the copyrights. Yes, so we need to find it how we can create the value, but without compromising the quality. If we paying piece rate to our workers, piece rate, yes. So what will be happen? Let's say we'll say your assembled table will pay you every table £10. Yes. So they will try to assemble as many tables they can. So because they want to earn more money as an individual, yes.
Yeah.
What if the shorty they will do exactly the right job? The problem can be quality.
Yeah.
So we need to be, then the quality leads to the customer satisfaction. Yes.
Yeah.
And sometimes say, no problem, Chinese products are not good or the price of quality is poor. But the price I paid it, yes, is fine. in that price. So we have to look around all and substitute, So always look as a management, as okay, as a manager, what we need to do, management is mean selecting best option. Yes, designing an environment. So if you have a good information, look various alternative and pick the best one. So that will help to reduce the cost. Okay, then the next technique is called product life cycle costing. Always look what will be cost at the start, growth, maturity, and decline stage of the product. Yes, that can be. So at the stage, we can set our promotional activities, our staffing, our inventory that will help us to reduce the cost. So here is example of life cycle costing and pre-production and after production, all we can look at. Okay, I copied here the link for, it's called value engineering. This is quite, value engineering is always like as an engineer, we're looking, all the possible options, where how we can bring the values. So I copied this link for you because we have a word is called value engineering. Like we discussed here at the top, the value, each step, how we can look around the value, how we can create the value. Okay, next now we're looking, I'll show you this value chain. So we can argue on it, which is Investopedia is quite good website as well, but we not use for our reference purposes because sometime the information maybe anyone can create it. So value engineering is a systematic, organized approach to providing necessary functions to project the lower cost. Yes. So different steps we can do. So it's quite good to read. Yes. So please. So please do so in your time. That will also help us to improve our understanding. Okay, next we're looking now. Third, a proposed business performance improvement. So always look around. If you want to propose something, you look around the cost driver. One is approach is called ABC costing. It's called activity-based costing. When your activities increase, what will be happen? Like say 10 times you're going home and coming office. Yeah? So your cost increase.
Yeah.
So what is driving the car driving is each travel, yes, or each delivery. So if is a delivery cost each time costs you 30 pounds. So if we do the route planning, yes. So if we'll do proper route planning, we can reduce this cost. If we reduce the delivery, like every day from Leeds to Birmingham, we are delivering things. So what we can do once a week a delivery. But we need to think about, we did the promise same day delivery. We're not meeting the promise then. Yes. So, but maybe we have in between, we have a Coventry, we have all other areas, and we can take, or we can advertise, or if we have a car sharing or delivery lorries sharing with someone else, that this cost will be reduced per delivery. Yes. So we think about all possible options because that's, so we have to identify which thing drive the cost. We have an example here, activity-based costing. Like we see here, we have a cost drivers, inward number of deliveries, 1,000 deliveries, 200 of these deliveries related to product X and others. So we can identify how much is cost goes towards product X and product Y, so on. Okay, next we can look around decision making. Decision making, as we said, selecting the best option. Okay, so we can look around the break-even analysis. Break-even is a point where no profit, no loss. Always we find the contribution. Contribution formula, selling price minus variable cost. So fixed cost divided by contribution per unit, so we can find what is the break even. So all the formulas which we will use in the next lesson, yes. So fixed cost divided by, and then from these, we can margin of safety level. So all these formulas which we can use to help, is cost volume profit analysis we called. And we've been given here example. So fixed cost was 5,400, 15 pound was the selling price, 12 pound was the variable cost. So if I'll sell 1,800 units, I will be break even. So if I'll increase my selling price to 1,820, my break even will drop. If I'll negotiate with supplier and reduce my variable cost from 12 to 10, my break even will drop. Yes.
Mm-hmm.
So then there is a sale to cost ratios. How much is we are selling profit? How much is costing us? So that ratios we can find. So on the basis of our target profit, how much target profit we want. So we have here is, yes. So fixed cost plus target profit divided by our contribution per unit. So we can find how many units we sell, we earn the desired profit. Any question?
No, it's fine.
Okay, so margin of safety mean what is your budget and what is the break even. The difference is the margin of safety. We can find as a percentage and we can find as a number. So these, the things we can look around and that will help us to reduce and reduction cost. Other we can look around limiting factor, limit. We don't have unlimited resources. We have a limit. We need to find the option where we use our limited resources effectively. Because some people don't have enough money, but they become richer. And some people have enough money, they become poor. Because they're not identifying and using the limited resources effectively. And not making the right decision at the right time, at the right place, with the right information. Okay, that's we can rank them. So ranking is very important. If is one product give a high contribution and one product give the low profit margin, so where I'll use my limited resources, I'll use those product will give me high rank, high profit. Like here, rank one, this product will give me £1.50 per machine hours if I use it. I have a limited machine hours available, but if I use towards production of product B, I can get £1.50 contribution per machine hours I use. But for the product A, I can get only 50 pence. So where I'll use my machine hour most, I'll use towards product B, not product A. Product A will be my second option. Any hours spare will be so that's other way to look around cost reduction. Okay, so this again we can look around make ourselves or you outsource them. Why we'll make, but always look around social accounting. If we'll everything we'll ask China to make for us as a company, as an organization, we'll carry on losing and employment opportunity in a country. So that's all we can. So really discounted cash flow will go through next lesson. Okay. So any question here?
No, it's fine.
Okay. Next we have today is the last point is it's called balance scorecard model. Balance scorecard. When you looking the quality and the profit, you don't look one perspective. Always look the financial perspective, which will mean the revenue and the sales and the cash, return on capital employed, gross profit. Then always look the customer perspective. Yes, delivery speed, time of delivery, sales surveys, yes, always measure that. Internal perspective, always look the total quality management, everything we do on the quality, we provide the training to our staff, then we can do. That's the internal perspective. Then you do innovation and learning perspective. Yes, innovation. So innovation, we look around as well, and that's mean bringing more latest technology and reducing the cost. So these are the perspective, and this is a continuous improvement. Yes, balance scorecard model we can use towards the continuous improvement. Any question?
No, it's fine.
Okay, so that's all today. We'll keep up to here. If any question, anyone, please drop me email. I copied the link, to do a bit reading for value engineering. There are a lot of examples. So that's also the cost reduction for management, financial control. Okay. So that's all today. In the next lesson, we'll go through LO2. If you have any question, guys, please drop me email on my email address, uk. Thanks for listening and attending. And I hope so. I'll speak to you all during the next class.
Mr. Andrew, why don't you